The Office of the United States Trade Representative, the USTR, has formally launched an unprecedented tariff strike against 60 global economies, including the European Union, the United Kingdom, and Canada, ranging from 10 to 12.5%. It has even slapped a 25% tariff on Brazil. This means global trade friction has escalated from targeted confrontation to indiscriminate extraction. Your cross-border supply chain costs and investment decisions will now face systemic shocks. This is geopolitics and economy. The content of this video represents only personal views and does not constitute any investment advice. Markets involve risk. Invest with caution. All right, I'm a Wall Street trader. Today, let's talk about 6 core issues that are reshaping the global economic landscape. The first issue is the indiscriminate tariff positional warfare. The market generally believed deglobalization mainly targeted U.S.-China bilateral ties. But the report reveals the USTR has launched a 10 to 12.5% forced labor tariff review against 60 global economies. Even traditional allies like the EU and the UK and Latin American countries such as Brazil have been hit with an additional 25% tariff. In other words, global trade logic has shifted from comparative advantage to geopolitical security dominance. The path for Chinese companies to bypass tariffs through transshipment trade is now almost completely blocked. So what's our countermeasure? The report points out we must completely abandon the illusion of entering Europe and America through third countries. Instead, we should pivot to the Southern Hemisphere, treating Africa and Latin America as key pools for China's excess capacity and low to medium-end consumer goods. This strategic shift will be crucial for China's foreign trade in the coming years. So, what does this mean for ordinary investors? Companies that rely solely on transshipment trade will see their risk exposure skyrocket. But companies that can truly root themselves in emerging markets and localize production will have a more stable valuation logic. Note, this is not just simple trade aversion. It's a deep restructuring of the supply chain. The second issue is the Middle East fake ceasefire and energy dual-track system. The Pilot Security Zone agreement between Lebanon and Israel is a ceasefire on the surface, but Hezbollah has publicly rejected it, and Iran-aligned militants have attacked Kuwait's airport. Trump even defined the ceasefire as shooting in a more gentle manner. In reality, this is just political rhetoric, unable to mask the physical reality that the de facto blockade of the Strait of Hormuz will extend into September. This creates a fatal dual-track system. Headline crude oil prices are suppressed below $100 per barrel by a short-term geopolitical news. But downstream products like Asian liquefied natural gas, the JKM price has surged to $18.24 per million British thermal units, far higher than Europe's $14.32. U.S. distillates, that is diesel and jet fuel, have commercial inventories only 2.3 million barrels above the 2023 extreme low point, teetering on the edge of a physical supply gap. So what does this mean? In the fourth quarter, the hidden energy costs for global logistics, chemicals, and manufacturing will skyrocket systematically. For Chinese companies, oil and gas giants holding long-term low-price agreements, like CNOOC and private refineries with heavy oil deep processing capabilities, will see major benefits. Conversely, those high-energy consuming cross-border logistics companies without adequate hedging, like Air China, will see the underlying logic of their profit recovery long-term damaged. Investors need to see through the surface and capture the real supply-demand mismatch. The third issue is the siphoning and debunking of AI computing infrastructure. The market once broadly favored AI computing investment, believing it to be endless. But Broadcom's recent earnings guidance missed expectations, triggering a concentrated sell-off in the NASDAQ AI sector. The NASDAQ fell 0.09%, but the Dow Jones hit a record high. Why? Because funds are rotating from overvalued hardware computing into defensive sectors like healthcare and financial blue chips. More importantly, upcoming IPOs from Silicon Valley giants like SpaceX and OpenAI are expected to absorb over $200 billion from secondary markets. This poses a severe liquidity drain for emerging markets, especially Asian chip giants like Samsung, SK Hynix, and TSMC. They face a double blow of passive capital outflow and passive underweighting in the short term. In other words, Wall Street is losing patience with computing infrastructure investments that can't quickly translate into profits. However, the report also mentions a contrarian signal. Samsung's foundry division is proactively reaching out to Chinese automakers like BYD to manufacture 2-nanometer and 4-nanometer high-end autonomous driving chips. This shows that, under TSMC's capacity crunch and geopolitical constraints, Chinese automakers are leveraging the excess capacity of Korean chaebols to achieve breakthroughs in the underlying hardware for smart driving. This will bring business pressure and price competition to domestic fabs like SMIC. So, my view is that the AI sector is entering a cycle of earnings debunking and valuation digestion. Blindly chasing hardware is extremely risky, but focusing on applications, especially the differentiated smart driving of Chinese new energy vehicles, could usher in new development opportunities. The fourth issue is the ghost revival of fossil fuels. Despite the global push for carbon neutrality, the report shows Western countries are making a strong comeback in their strategic reliance on fossil fuels. For example, the U.S. Energy Secretary ordered coal-fired power plants in Florida to continue grid operations to address a grid reliability crisis. President Trump also loudly announced a $700 million special investment in the U.S. coal industry, clearly aiming to defend beautiful, clean coal. And Germany has completely broken decades of military caution, skyrocketing its defense budget from $96 billion to $123 billion, reaching a total of $169 billion. Rating agencies predict this will bring an additional 0.8% GDP growth to Germany. This is a historic turning point, as the German economy shifts from an export-driven model reliant on cheap Russian energy and the Chinese market to a wartime defense-driven model. This will inevitably squeeze resources for traditional automotive and precision machinery manufacturing. So what does this mean? Amid extreme geopolitical security and energy anxiety, Western countries' carbon neutrality timelines are being effectively shelved. The strategic pricing power and physical control of old energy are making a strong comeback. For investors, this means the value of traditional energy assets could be reassessed, and companies benefiting from military orders and energy self-sufficiency strategies will see new growth space. For instance, German defense giants like Rheinmetall have risen against the trend. This also confirms from the side that geopolitics' impact on the economy is far greater than we imagine. The fifth issue is the emerging market liquidity drought and the ruble's predicament. Emerging markets are currently in a passive defense position. For example, foreign capital is continuously selling off in the Indian stock market, with a single-day net outflow as high as 56.16 billion rupees, putting pressure on the rupee. India's finance ministry is considering offering tax relief on government bonds to foreign portfolio investors to offset capital outflows. Russia's wartime economy is even more deeply fractured. The military-industrial complex is in a false boom under state budget favoritism, with military semiconductor output surging 2.8 times. But the civilian economy is rapidly hollowing out, with construction, metallurgy, and civilian automobiles all in severe decline. To plug a massive deficit from compensation payments of 14.2 million rubles per fallen soldier and enormous military spending, Russia's finance ministry is forced to issue huge amounts of debt. However, with the central bank's benchmark rate sky high, long-term bonds yielding 14.8% are going nowhere, and the forced issuance of floating rate notes is dragging state finances into a black hole of debt servicing. Putin tries to hide the trouble, but the real inflation rate of 20% for food and medicine is ruthlessly eating away at the living space of ordinary people. So what does this mean? Emerging markets face severe liquidity challenges amid a strong global dollar cycle and geopolitical conflicts. And Russia's woes provide a deep-seated substitution dividend for China's low to medium-end manufacturing, but may also intensify cross-border trade settlement frictions, with the ruble continuing to weaken. Investors need to be wary of the risk of passive underweighting in emerging markets and monitor potential market opportunities from Russia's internal economic rift. The sixth issue is the epic migration of the pricing anchor in decentralized finance. The crypto asset market is undergoing a fundamental logic restructuring. while Bitcoin and Ethereum spot ETFs faced massive sell-offs. The Solana ETF bucked the trend with net inflows of $80 million in a single month. Even with Solana's spot price falling below $68, institutional money is still building positions against the trend. Why? Because the Solana ETF is the first ETF to support staking and generate yield, combining beta returns with fixed coupon characteristics. The report points out that Wall Street's mainstream valuation model for crypto assets has evolved from the traditional pure store of value digital gold to underlying yield generation capability and cash flow expectations. In other words, the pricing anchor for decentralized finance is shifting from pure speculation to assets with real cash flow and yield-generating capabilities. This marks a deep convergence between Web3 infrastructure and traditional financial logic. So, my view is that the investment logic for crypto assets is undergoing a fundamental change. Coins relying purely on hype and consensus will become increasingly risky. But blockchain projects that can generate yield through staking and produce actual cash flow will gain institutional favor. This is a milestone historical inflection point for the Web3 sector. Investors need to focus on crypto assets that truly possess underlying yield generation capabilities.